Welcome to the rate stuff as Donald Trump's tariff bombshell detonates on global markets.
Yes, bad news if you have a pension or investments, but perhaps good news if you're a mortgage holder.
Stock markets are plunging and there is a recessionary juggernaut seemingly heading our way. But, as you say, Peter, potentially some good news on mortgage rates.
Yes, one person's bad news could be another person's good news as mortgage rates look set to fall.
Welcome to the rate stuff. I'm Jack Izzard.
And I'm Peter Stimson.
Strap in and stay with us as we unpack what all this means for the mortgage market and where we might go now. Picture the scene. You're looking wistfully out to sea. You can feel the breeze in your hair. It's 2 for 1 on cocktails, and somewhere there's a band striking up. That's when you realise you're on the deck of the Titanic and a big iceberg has just hoved into view on the horizon. And it's a little bit like that in the mortgage market right now, Peter, isn't it? We've got this horrendous recessionary juggernaut seemingly heading our way. But if you can ignore that, actually quite good news on interest rates at the moment.
It's good if you're a mortgage holder because swap rates have dropped by around 30 basis points, and that's going to get priced into mortgage pricing over the next 3 or 4 days. So that's good from that side of things. Obviously, you're going to have a job to obviously afford your mortgage payment on the sort of more serious side of things. So yeah, swaps have come off around 30 basis points. So mortgage rates will be following that accordingly.
So let's unpack why that is. Obviously, this is all in response to Donald Trump's Liberation Day, this big announcement of global tariffs. He's effectively triggered a global trade war. And it's the fear of recession, the idea that these increases in tariffs, the taxes charged on imports, will just send the US into recession, potentially the UK, maybe the whole world. So that's what's driving down swap rates at the moment, isn't it?
Yes, it's a fear that the UK economy and indeed the global economy is going to go into recession, and interest rates are used to stimulate the economy. So it's essentially that the Bank of England is going to have to cut interest rates harder and faster than it would normally do. So we're now looking at potentially three interest rate cuts this year, whereas before the markets were pricing in 2. So first one is now looking at the 8th of May. That's looking fairly certain, as certain as you can be at the moment, and potentially 2 the rest of the year.
So let's work the numbers. So base rate currently 4.5%.
Yep.
They tend to cut by 0.25% when they do a cut.
Yes.
So if they cut in May, as we think they will, and then potentially twice more during the course of this year, that would take us, if my math serves, to 3.75% by Christmas.
Yes. I mean, long way to go. And as you've seen with Donald Trump and his policies, a lot can happen, not just in the next week, in the next 24 hours. So, an awful long way to go before we get to Christmas. But yeah, 3.75 potentially by Christmas.
Okay, so that will bring mortgage rates down, but we're already seeing the dial move on mortgage rates. We've seen a wave of cuts already this week, and you think there could be more in the coming weeks as lenders seek to cut aggressively and win market share?
Yes, I mean, you'll see lenders cut in the next few days. Depending where the swap rates go, the swap rate is very volatile at the moment. Markets are still trying to come to terms with, really what this means, how it's going to play out. You're still seeing governments react in terms of, what countermeasures they're going to put in against Donald Trump. Some of the countermeasures will be inflationary. So, that's going to, act as a pull or a brake on swap rates as they react to that. So lots can happen. But yeah, at the moment, we're looking at, cuts over the next week or 2.
And what about 2-year versus 5-year? Are they all going down across the board? Any difference there?
They both dropped more or less the same. So it's basically gone down about 30 basis points in the last week. What brokers probably need to think about is what happens if Donald changes his mind. So what happens if the tariffs get a 30-day moratorium, if some of the countries start persuading Donald to maybe change some of the tariffs. Some of the swap rates could start going up again. And I think brokers perhaps need to think about some of the value, particularly in some of the longer term fixed rates at the moment. So, it isn't this sort of guarantee that fixed rates keep falling continually from where they are at the moment. So at the moment, we've got 3 bank base rate cuts priced into the curve. This isn't a certainty for that rates are going to continue to fall infinitum. So if customers are concerned about, their payments and want some sort of certainty, some of the longer term, maybe 3 and 5 year rates are offering some sort of particularly good value at the moment. So, brokers might want to think about that if they're sort of wondering whether they look at, 2, 3 and 5 year at the moment.
Let's just rewind to that point you started with, which is the idea that, yes, short term, great, mortgage interest rates are going down, but there is that big recessionary fear.
Yes.
There must be a concern now that if a recession hits hard, people will lose their jobs, we'll start seeing defaults rise. So that's probably in the back of lenders' minds as well.
We need to think about, how big a recession the UK goes into. At the moment, the UK doesn't have a particularly big, export of goods. We're much more a service economy. So although the UK, Trump has only put 10% on the UK, first of all. Secondly, we export much more services rather than goods, and services aren't subject to tariffs. So, we aren't in the same position as a lot of other countries. So yes, whilst a recession is a possibility, we need to sort of be mindful about, the potential impact. So yeah, it's not looking potentially as bad as it could be for other countries.
Okay, so maybe not a hard recession, but certainly nothing like the growth that we were seeing forecast a few months ago.
The numbers will need to be revised, I would imagine, depending where we see this play out.
Well, of course, we saw the OBR predicting GDP growth of 1% in 2025 ahead of the spring statement in March. Is that looking a bit optimistic now?
I would imagine not just for the UK, for the whole of Europe, numbers are being rapidly revised at the moment.
Well, this is the Donald Trump effect. In the space of a few days, he has upended global trade. He has upended the economic prospects for the UK and the prospects for interest rates too. Now, much as she might like to be compared to Donald Trump, Liz Truss is not Donald Trump. And yet there is a strange parallel between the disastrous mini-budget of the Liz Truss premiership here in the UK and Donald Trump's Liberation Day shocker. It's a bit of a funny one, this, Peter, isn't it? Because we're seeing very rapid movements to the swaps market. But this is not really the same as the Truss moment. It's kind of the inverse Truss moment, isn't it?
It is. People are starting to sort of draw strange parallels between Donald and Liz, and yet they're quite different. I think the comparison is the markets are sort of basically losing complete faith in both of them. So, you can see kind of what's happening to the stock markets so around the world, and that, they don't believe in Donald Trump. They don't have any faith in his policies, and the markets had no faith in Liz Truss. So there's a comparison there. But, and the swaps markets and the bond markets are sort of, going down, whereas Liz Truss, they went up, but it's for completely different reasons. Liz Truss was unfunded tax cuts, which would mean, huge borrowing, which would obviously, meant that swap rates went through the roof, or bond yields went through the roof, which had the same effect on swap rates. Donald Trump is the opposite. So, bond rates are going down massively for fears of a recession. Yeah. So different reasons, but basically they're both being sort of compared in sort of loose fashion because people have no faith or trust in them and basically think their economic policies are basically basket cases. So
yes, so similarities in terms of the speed and the severity of the reaction.
Yes,
it's the polar opposite, if you like. We're seeing swap rates plunging this time round.
Yes,
of course, one of the reasons that Liz Truss was the shortest Prime Minister in British history was because the markets lost faith in her. Could you foresee that we see something similar with Donald Trump?
They had a mechanism to get rid of her, I think, was the difference. Right. So the Conservative Party, the way a Prime Minister is sort of elected and sort of held in office. Out came the rug, and her sort of, her parliamentary colleagues sort of got rid of her, and she just about managed to outlast the iceberg lettuce. I think Donald's quite different.
I think lettuce won, actually, didn't it?
It was tight. I can't quite remember who managed that. Donald, unfortunately, is slightly different. So yes.
Yes, yes. Only 45 more months to go, Peter. Look on the bright side.
Well, there's the primaries, I think, isn't there, or the midterms in a couple of years. So I think that may limit his power, but we'll see.
Okay, so let's work on the assumption that Donald Trump is not going to do a truss and be booted from office, and he will serve his full second term. Of course, he's quite keen to serve a third term.
Well,
we'll see about that. Yes,
Yep.
there's a small matter of the Constitution and all of that. It wasn't a problem for Putin a few years ago, but TBC.
yes.
TBC. But assuming he serves out his full term, the question is will he change mind? I mean, he has been quite volatile in the past, and big policy decisions on a Monday are reversed and forgotten about by a Friday. And what would happen if he unpicks all this tariff stuff?
Well, we've seen it before on several occasions with Canada and Mexico. He's put tariffs on, and an hour later he's taken them off. I mean, we haven't seen any sign of that yet. But if he were to do that, I think there's all signs that the global markets could recover quite quickly. There's talk of him perhaps putting a 30-day moratorium on some of these tariffs to negotiate, and whether this is indeed just a negotiating stance. If he were to do that, I think there's a fair chance some of the sort of reduction in swaps we've seen would actually reverse quite quickly. So again, particularly if you're looking at some of the 5-year, 3-year swaps, if your client is looking at maybe taking advantage of these positions, now's a good time to do it. So again, what we're sort of seeing is none of this is certain. There's so much volatility going on. I wouldn't assume again that the reductions we're seeing now are locked in and are sort of here to stay. Donald Trump is an extremely volatile individual. We could wake up tomorrow morning and decide he's going to reverse it. You could do something slightly more dangerous and something slightly worse. We just don't know. So don't take anything for granted is all I'd say. It's
a very strange set of affairs, isn't it, where we're sitting here awaiting the whims of a US president before we deciding what to do with mortgages here in the UK.
Exactly. We await his next tweet, is unfortunately the position we're in, or the world's in, unfortunately.
Okay, let's assume, though, that things do proceed in that kind of linear direction and rate cut after rate cut after rate cut. That raises the question of how low do we want rates to go? It's tempting as brokers to think the lower the better, and we want to see those 2%, 1% interest rates coming back.
Yes.
A month or two ago, we would have said, never going to happen, that's impossible. Now, it doesn't sound quite so outlandish, but do we want rates that low?
I think that's a very big question. I think that's not great from a global economy perspective. The economy is going to have to be in a very bad place, first of all, to get rates to that position. Well, inflation is going to have to be incredibly low. The economy is going to have to be in a very bad position. But I think there's also a broader question about the housing market and what it means for the housing market and affordability. But that's probably a question for another time.
I think so. Let's put a pin in that for now and be careful what you wish for. As Peter was saying, it is possible that we'll see rates fall lower and lower and lower. But how low do we want them to go? Is there such a thing as a Goldilocks interest rate? Not too high, not too low. That's a topic for another day here on The Rate Stuff. I'm Jack Izzard.
I'm Peter Stimson.
Thank you for joining us today, and do join us next time as we unpack what the mortgage market means for you.